You're about to listen to the Yet Another Value podcast. Today's episode is on Jardine Matheson. Jardine Matheson is a holdco trading at the sum of the parts discount. Our guest Dom from Cayucos Capital has done. He's got a 200-year history here. It's really interesting. It's an interesting discussion, and I think the thing in the back of my mind is 10 years ago when I first started out, I used to love holdcos. It was all I did. You take a company, hey, $100 per share of like tangible value, trading with 50 of cash and 50 of stocks and trading for 80. Awesome. And over the years, the history of holdcos over the past 10 years has been awful. And that's, holdcos with shady management teams have been terrible too. But also a lot of the greats who had holdcos, they have done really, really poorly. I'm looking at you, IAC. I'm looking at you, Liberty. Several others, they've really underperformed. So I've gotten really skeptical of holdcos over the past 10 years. I think you'll hear that in the conversation. I think it makes for interesting divergence of style. So we're going to get there in 1 second. But, obviously international stocks. So full disclaimer, extra risk in international stocks. See our disclaimer at the end of the podcast. But we're going to get to the podcast in 1 second. First, a word from our sponsors. This podcast is sponsored by AlphaSense. Look, AlphaSense has been a longtime sponsor of the podcast. I am a super happy user of the AlphaSense products, everything ranging from their AI platform for investing, but particularly the expert calls that I use on a daily basis to look at companies and kind of see what industry insiders who are doing more than I'm doing, which is just being a dummy and reading the publicly traded filings and reading industry insiders are telling me about how business is actually working on the inside and how they're viewing trends and everything inside it. So super huge fan of the platform. If you're interested, AlphaSense was kind enough, they just sponsored a free webinar with me and a former at MasterCard where we talk about the future of finance. In particular, we're talking about stable coins and their effect on the overall economy, how they could impact remittances, how they could impact particularly payment networks, because he's a former at MasterCard. I think is a really fascinating interview. I think you're going to, whether you're a generalist or a specialist who focuses on that, I think you're going to learn a lot listening to it. And if you listen to it, I think you're going to, see why I think expert call networks are kind of the most revolutionary product for investing, for generalists, for specialists, for everything to come along in the past 10 to 15 years. So if you're interested, I'll include a link in the show notes to go check out that webinar. But thank you to AlphaSense for sponsoring this podcast. And now onto the podcast. All right, hello, welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. With me today, I'm happy to have on for the first time, Dom St. George from Cayucos Capital. Dom, how's it going?
Good, thanks. It's a real pleasure to be here.
All right, I'm super excited. Before we start talking, just remind everyone on this podcast, nothing on this podcast is investing advice. Always true, but we're talking about an international stock today, so that carries extra risk. Consider that. See the full disclaimer at the end of the podcast. Dom, the reason you're hopping on, you did a great write-up on your Substack. I'll include a link in the show notes for anyone who wants to go read the full thing, but it's on Jardine Matheson. The ticker there is JM, but it does trade international, so people will have to kind of go find that. You've been covering, I thought what was so cool is 2/3 of the way through your write-up, you mentioned, hey, I've been following this stock since 2012, I think, so you've been following it for a long time. But I will just pause there and ask, what is Jardine Matheson and why are they so interesting?
Yeah, thank you. So I love to delve into the ancient history of companies. And so I can't get going without talking about the founding story here because it's just so fascinating. So most people will be aware of the East India Company, which in the 19th century had a monopoly on trade with India, the British East India Company. And fewer maybe will be aware that one of their main exports out of India was opium. But the East India Company,
I think if you've ever watched a TV show with like a little historical fiction, I think they make it pretty clear what was coming out of the East India Company, to be honest with you.
Okay. So maybe more well known than I thought. But so they didn't want to actually send their people into China directly. They didn't want to ruffle too many feathers. So they left the actual import of opium into China to enterprising traders such as Jardine and Matheson. And William Jardine in particular made so much money from this trade, as you can imagine, that he used that wealth and also his seat in the House of Lords, which is similar to the Senate in the UK, to lobby for the end of the monopoly that the East India Company had. And eventually he was successful. And so, the East India Company tried to kind of limit the flow of opium, whereas when that monopoly ended, you had a complete free-for-all of opium coming into China, and that's what forced or made China decide to ban opium outright. And that was so deleterious to the British Empire that they went to war with China over that ban. And it was the subsequent treaty after that war that led to the creation of Hong Kong as a British colony. So basically, the history of this company led, in effect, to the creation of Hong Kong as a British colony. So let's fast forward a couple of centuries, and Jardine Matheson, really, for context, I describe it as a perennial value stock, and anyone with a value inclination in Asia probably sort of groaned when they saw somebody pitching this stock, because it's been cheap forever. And the reason for that is that the group essentially made a levered property bet in the mid 80s, which turned out to be very poorly timed. It came months before the British and the Chinese announced the eventual handover of Hong Kong back to China, and that led to a property slump, and the company started to be circled by would-be suitors. And so in order to avoid takeover, the group basically instituted a very complex cross-holding structure where they had two holding entities, each with controlling shareholding in the other, which essentially made it impervious to outside influence. And so anyone who's looked at this over the years, as you mentioned, I first looked at it in 2012, it's always traded at a large discount to NAV or some of the parts, but ultimately, who cares? But there have been some quite substantial changes in recent years. So it seems that Ben Keswick, who's the fifth generation of the family, has sort of consolidated control over the group. And he's done a number of very interesting things. So the first thing is to unwind the cross-holding structure. So there's one clear holding company, Jardine Matheson. Secondly, there have been a number of disposals that the group has made across the group, which I add up to around $4 billion, which is pretty substantial relative to what is today an $18 billion market cap. And so the group has been the third thing is that the group has been very, very insular historically. They had a graduate scheme which trained people up, and basically all of the senior executives were lifers. And the thing that really caught my attention was that they announced earlier this year that they were bringing in a new CEO, a gentleman named Lincoln Pan, who was and is the co-head of private equity at PAG Group, which is one of the largest private equity groups in Asia. And when I started to dig some more, I realized it wasn't just him. They have a number of senior sort of big swingers from private equity on the board. So there's a gentleman from KKR and a lady from Carlyle. If you look at who's now heading up the China business, it's a guy called Steve Sun, who was co-head of China for TPG, and his number two was a senior investment banker for, I think, the head of Asia for Bank of America, Merrill Lynch. So it's and just to reiterate, so Lincoln Pan actually starts on the 1st of December in a couple of months' time. So despite the $4 billion of disposals they've already done, it's quite clear there's a lot more to come, and they've sort of given us a roadmap for some of that, which I can get more into.
That's great. So let's just pause there. Okay, so you've got a company with literally centuries of history, right? And what you're saying is, hey, fifth generation kind of comes in. They've been in it for a while, but they've really just cemented their control, hired a bunch of outsiders with deal experience who are coming in, and you think the path from here is great. So let's just start. Normally I ask, why is this an alpha opportunity? But I think you kind of laid out. I think place to start would be, hey, as you and I are speaking here today, frame the upside for me. The stock is trading, if I just pull this up, the stock is trading at $63. I guess that's HKD, but it's trading at
it's actually US dollars.
It is, okay. It's trading for 63-ish per share. What does NAV look like here? What does value look like here?
Yeah, so again, I've done some of the parts. Almost all of the entities of the group are publicly listed, so it's pretty easy to do. And so I get to basically a 16% discount to NAV, which is not very exciting in and of itself. It's more all of the potential corporate activity that could happen.
Then we could go through the different pieces of the NAV. I thought one of the really interesting pieces is they've got Hong Kong land, and there's the market price, and then they say, hey, if you look, these are trophy assets. We think the real value of them is like 2x the market price. I thought that was interesting. We can talk about all those pieces, but as you said, one of the questions I'm going to come back to is, hey, 16% discount to NAV, that's not that interesting to holdcos. What is the go forward path that makes you so excited? What is the go forward path? Because if you told me 16% discount, they're liquidating tomorrow, I'd say, oh, that's pretty cool. 16% discount, like what are they going to do to grow NAV, or that we're going to kind of, as I like to say, what are they going to do that we're going to capture a risk-adjusted alpha opportunity by buying the stock at a 16% discount to NAV?
Yeah, so I think it would be useful to start getting into the businesses. And as you said, so very roughly, you got 1/3 Hong Kong land, 1/3 Astra International, which is the largest business in Indonesia by revenue, very broad conglomerate, and then 1/3 everything else. And so starting with Hong Kong land, it's about a $13.5 billion market cap today, and they own 53% of it. But they would tell you the net value of their assets is actually $35 billion. And so, what's the differential? One, they're a little bit aggressive in terms of the cap rates they use. So the biggest portion of it, about 2/3 of it, are Hong Kong office. Hong Kong office is about half of Hong Kong land. And then a little bit more comes from Hong Kong malls. And they use a 3-ish% cap rate on those assets. So you could say, well, that's a little bit aggressive. But one data point that is quite interesting is that they actually sold one of their space. They sold 9 floors of one of their prime Hong Kong towers earlier this year to the Hong Kong Stock Exchange at roughly, a similar cap rate. And I also think that's quite symbolic because, as I say, it's basically the jewel in the crown. It's the asset that they almost went bust buying in the 80s. So it kind of demonstrates to me that, they're willing to sell anything and everything. And so, again, $13.5 billion market cap. They've announced that they want to do up to $10 billion of capital return by 2035. Now, that's quite a long lead time, obviously, but it's because most of it comes from basically winding down the development assets that they have. They're building office towers and malls, mostly in China.
So when we talk about the 16% discount to NAV that Jardine Matheson trades for, right? We're talking about on the Hong Kong land, which is about 33% of their NAV. You're using the market price to get there. They're saying, hey, we think this is worth more than double the market price. Who do you think's right? Do you think they're right, or do you think the market's right here?
Well, I think it's somewhere in the middle. I don't want to say that the market is wrong, but I think the reason it's interesting is that they are actually making steps to realize that NAV at close to their cap rate.
What's interesting here is if I just do the math in my head, right? If they've got $33-ish of their $100 per share value, if I'm just kind of doing that as a NAV, at market price, if you say they think it's that 33 is worth 66, you think it's somewhere in the middle, so it's worth 50, that takes your NAV discount from 17% to about 33% just on that alone. I guess my pushback would be like, look, I've done a lot of these holdco investing. When I first started, all I was doing was holdcos to my detriment, right? I just love these things. And I was like, oh, these smart families that control. over time, I've gotten really disillusioned with them. And one of the reasons I got disillusioned with them is every time I had a control holdco that said, hey, we've got this crown jewel, we think it's worth way more than anyone again. Traditionally, it was actually really bad. And it was bad in one of two reasons. A, they way overvalued it, or B, they way overvalued it. And because the market was trading at 33 and they thought it was worth 66, they plowed more money in it. And then when the market turned out to be right, they had wasted all the money. So I guess when I look at them saying, hey, crown jewel worth these low cap rates, like I get really worried that it's got the traditional disillusionment of holdcos, if that makes sense.
Yeah, I mean, I think you're totally right. And actually, I'm always very hesitant to describe myself as a value investor. And the reason for that is similarly, I've discovered that a lot of the mechanisms to recognize value that exist in the US, activists, for example, private equity, directors with statutory responsibilities to minorities, even bankruptcy, transferring assets from bad owners to good. A lot of these mechanisms, they just don't exist, or they exist to a lesser extent in emerging markets or even internationally. So you do have to be very skeptical. And so, alignment with the key decision makers is very important. But I think there's just so much evidence here that they are shifting the portfolio from.
Great. Let's go to that then, right? I think the crux of your thesis is, hey, you have this company where the fifth generation, even though they've been there for a while, they really just cemented control, right? The fourth generation, as you say in your write-up, I think you've got science progresses by funerals, and you say that's how family holdcos work too, right? The fifth generation really just took full control because the fourth generation died out. And you say, hey, they're bringing in these heavy hitters to be the next CEOs, right? They're bringing the private equity firm. And I get that. That is exciting. You say, hey, they're only bringing in the private equity for, heavy hitters for one reason. The private equity heavy hitters are going to be on the other side of investment bankers and other private equity firms and deals. And I think you allude to that being asset sales and capital returns is kind of where your mind. That's not where my mind goes. Like, this is a fifth generation family old company. I don't doubt they're going to sell some, but what you're kind of suggesting is a wind up. And when I see them hiring a former B of A, head of private equity, what I see is, hey, we're going to go do a lot of investing. And yes, maybe we sell the old stuff, but we're going to be full speed ahead building out a family holdco. This is going to be a conglomerate. And I'm worried that's the direction they go, because if that's the direction, 16% discounts in half. Now, maybe they hit home run after home run. I don't know. But I think the base rate is, when you're doing a family holdco and investing, the base rate is the investments are done with a quote unquote long-term time horizon. And that's quote unquote long-term time horizon because they all underperform. And you say, hey, 1 year is going to be our year. So I threw a lot out there, but what do you kind of think about just like that go forward? Because I think that's where you think the catalyst is.
Yeah, I mean, to be clear, I don't think this is going to be wound up and the whole thing's going to be taken private. I'm arguing for simplification, and there's so much low-hanging fruit to achieve that simplification. And I think you are right. So if we get into the people who they've hired to run Hong Kong Land. So again, outsiders, the CEO who's hired, also a CIO, Chief Investment Officer. Both of them came from Mapletree, which is the real estate subsidiary of Temasek, the Singapore sovereign wealth fund, one of the biggest investors in Asia. And interestingly, they both before that were at Goldman Sachs. And at Goldman, they did a lot of the REIT IPOs in Asia. And if you look at their presentation, they are saying we're going to go from about $40 billion of assets under management to $100 billion, in part by managing third-party capital. So they're going to become, in part, more of an asset manager, as opposed to just owning 100% of everything and trying to generate returns that way. So that it's the plan long term is to become more of a fee business, and that the people they put in charge are indicative of that.
I mean, that is certainly interesting, but it's a lot of money to raise, and you have to hire a whole team and build out. Let me ask 2 questions. Base rate. Have you seen family holdcos successfully build asset management businesses like they're kind of suggesting here?
That's a good question. I mean, I have seen family companies raise third-party minority stakes in group companies.
Generally for Exor is going to buy The Economist. They buy 80% and they bring in co-invest for 20%, right? But that's more co-invest. Like they're talking about going from 40 to 100 billion. And if they could raise 60, let's just say it's 60 billion of outside capital at 1 in 10, I mean, you would put a feast, you would put a multiple on that. That would be worth quite a bit of money. That would cover a lot of overhead here. So I'm interested, I can't think of any examples of one having done that. Doesn't mean it can't be done, but if they could, and it seems like that is interesting. I just can't think of one that's done that.
Yeah, I mean, I think it's the direction of travel. I mean, whether they're going to get to 100 billion, I mean, that's quite an aspirational thing. But I do think if the more they can do to demonstrate that the 3% number, 3% cap rate they're using is actually a number that people are willing to pay, third parties are willing to pay. I think that's all positive. And again, the $10 billion they want to return from Hong Kong land by 2035 is a slow pace. But, just this month, they announced a $660 million sale of a Singapore, Malaysia-focused residential developer. So, it's a business, I didn't really know even existed, that they sort of plucked out of their portfolio and put a $660 million number on it.
Not bad when you don't even know there's something in there and it returned. Let me ask this question a different way. This is a holdco, fifth generation. He's hiring a bunch of private equity people. Forget what I said about third party. You've done a lot of holdcos. I've looked at a lot of holdcos. Can you think of family-controlled-ish holdcos that have transitioned to kind of the professional group? They're hiring a private equity firm. They're hiring firm bankers. Can you think of one that has done that and kind of done well?
Well, I mean, you mentioned Exor. I think that would definitely be up there as one of the best.
It's funny you mentioned Exor because I'll just transition to next. You talk about the 16% discount to NAV. Exor has done quite well in terms of NAV and compounding. I looked at Exor when I was prepping for this. Exor's NAV, they paint it as 180 per share, and they're trading at 80 euros per share. So I think the results have been good. I haven't followed them as closely as you used to, but I would just say like they're trading at 40% of NAV. It looks like if that's right, like if that's a good case here, careful what you wish for, I guess.
Yeah, I mean, the market in general does not like conglomerates. I think that's absolutely clear. I mean, there's a family conglomerate in South America that have made phenomenal decisions long term.
Is this Prosus?
No, this is it's called Cayucos. It's quite a small free float, but it's a Chile-based group, and they've made some fantastic decisions. But again, you're right. The discount to NAV is I haven't looked at it very recently, but it's kind of 50-60%. So the market doesn't give businesses credit, but every dollar that's returned to shareholders, I value that dollar in my pocket at a dollar. So if a lot of it comes back to us, then that can lead to good returns.
I actually think what you just said is what I was kind of trying to strive at as my risk factor, right? Like to me, a family holdco. A holdco at a discount is great if they're going to return the capital, right? Like a liquidation wind down. I think what I'm worried about here is, okay, Hong Kong land, right? They sell and they realize it's trading at a 6% cap. They think it's worth 3. They realize at a 4.5, 4, whatever it is. Like what I'm worried about is because they hired all these PE guys, the answer is not going to be take that money from Hong Kong land and return it to Jardine Matheson shareholders. Now, Hong Kong land might return it, but once it gets to the Jardine Matheson levels, I think you've got these PE guys who are going to say, all right, it's time to go buy something, right? And the history of that is poor. And I worry, I haven't followed Exor closely in a while, but I kind of worry you go get the Exor treatment or you get the South American treatment you're talking about where, hey, they do great sales, they go plow it into new businesses, and the stock just lags and it just keeps trading under NAV, and you have just kind of a perennial underperformer, I guess would be where I'm trying to drive my worry to.
Yeah, I mean, it's certainly possible. And, to be clear, the recent history of the investments that this group has made over the past decade have been very poor. And I guess one of the things that's interesting to me is a big part of that $4 billion of disposals they've done in the past 4 years, that's unwinding past acquisitions. So it seems very much like they're in sell mode rather than buy mode. But it is possible that once this sort of private equity team is assembled, they're clearing the decks in advance of that, and then they will go out and do more M&A. I mean, I think they know that the market will not look fondly on M&A, but you're right, they may not especially care.
Are you familiar with Liberty Media at all?
Somewhat, yeah.
I was reading John Malone's book. We just did our book club on it. And the thing I was laughing at is every decade, AT&T can be trusted to make a terrible acquisition and then unwind it. But, when you're saying Jardine Matheson, one of the reasons they get into the complex holdco structure is in the 80s, they buy real estate at like the height of the market, right? And it takes them almost 40 years to unwind that evil. And then in 2020, as you say in your write-up, one of the reasons they get in trouble is in early 2020, they buy 4 billion plus of Chinese real estate, and then COVID hits, and the real estate is probably the ink is dry on the parchment, and the real estate's probably down 90% by the time the ink's dry. And it kind of reminds me of AT&T, right? And now we're saying, hey, they've got these new guys, these outsiders, and I'm like, yeah, they're gonna sell a lot of stuff, and I would not be surprised if 5 years from now, Dom's on, and we're saying, hey, sold a lot of stuff, and they moved into AI at the absolute top of the market, and it was bad or something,
Yeah, I mean, I would say that I think as you say, very poorly timed acquisition of a big parcel of land in Shanghai in 2020, I think that could well have been the sort of straw that broke the camel's back and convinced them, okay, our track record is not very good over the last 10 years. Let's bring in outsiders and really radically change the strategy. That's the optimistic take.
One of the things that struck me reading their annual report is annual report, semi-annual report, all this huge focus on our goal, our North Star is 5-year. What's the exact quote they say? It's 5-year superior is the quote. Superior 5-year total shareholder returns. And it is kind of funny because when you read the annual report, their 5-year return is negative. And, indexes, they don't comp to an index, but indexes are not negative over the past 5 years. But I just wanted to ask you about that. Like when they talk about that and when they talk, we can talk shareholdings and stuff in a second. But when they talk about like, how do you think about when they're saying we want to drive superior 5-year returns, how do you think they're thinking about it?
Well, I think it means an asset-light strategy. So, I talked a bit about Hong Kong Land and what they want to do. One of the smallest but most high-profile parts of the group is they own the Mandarin Oriental chain of hotels. So there, again, they've talked about moving towards a management model rather than owning the real estate and owning and operating. And they've already sold a couple of hotels. They sold Washington and Paris, one of which they retained the management contract. So that's sort of indicative of what they want to do. As I say, an asset-light model, and then also simplification. So in the third bucket, the other bucket, the biggest chunk of that is a retail group called Dairy Farm International. So historically, that was Hong Kong, as well as Singapore, Malaysia. They had grocery stores in Indonesia, the Philippines, and all of those have gone now. They've all been sold. So it's again a much more simple group. It's basically just Hong Kong. They run the IKEA franchise in a few countries, and they're the 7-Eleven operator across a few jurisdictions. So it's radically simpler than it was. Has very little debt now, and so that. Both those entities, so Dairy Farm is owned 78% by the group, and Mandarin Oriental, which they've been buying, they own 88% of. So very easily they could privatize those assets.
I did not realize Mandarin Oriental was publicly traded, and obviously they own 88%, so publicly traded is kind of a loose thing. But I do think that's interesting. Like that is a place where I could see a family holdco with a long-term vision really creating something, because for those who don't know, Mandarin Oriental is like I'm not staying at 1,500 a night hotels, but I believe it's about the highest end hotel chain out there. And they're building it 40 units. Like, you could imagine how every new unit they build, and obviously there's a cap on that, right? They're not going to build, I love Lafayette, Louisiana, but they're not going to build a Mandarin Oriental in Lafayette, Louisiana. There's a cap on just how many they can have, but every new trophy Mandarin that you build in Trophy City kind of adds to the network. And you have to imagine if and when they ever put that up for sale, every large hotel group that's going to be a trophy property that a Marriott would bid out the nose for, because they want access to that customers. It's a hugely synergistic piece of their business. The CEO probably wants to stay at the Mandarin instead of the Westin when he's traveling around, if you're being completely honest with everyone. So I think that's a really interesting example of a place where a family holdco can maybe take a longer term view and create value. Anything you want to say there or add on to that?
Yeah, I mean, luxury hotels are one of those things that you have to tick off the list if you're a mega billionaire. You want to own a sports franchise, massive jet, and you want to own a chain of hotels, or one flagship hotel in New York or something. And so
it's funny you say that. They really do. And I get why you'd want to own a sports team. I get why you'd want to own a jet. I don't know why you'd want to own the hotel. Like, why do you want to own a luxury hotel? What's the point?
Well, it's the VIP treatment that you get. There's no better directorship than being on the board of a high cost airline, because you get the VIP treatment. But so on the subject of hotels, so it's quite interesting. Let's say you own a commercial tower, office tower. You get to hold that as investment property, and so you get to basically mark to market every year. You get to use a cap rate and market to market every year. Whereas hotels, it's a very similar asset, but it's the way it's held. It's a depreciating asset, and so it's kind of disadvantageous to run a building as a hotel as opposed to an office. And so Mandarin Oriental owns a lot of its land and property assets. And actually, so they had an old hotel in Hong Kong, and they decided to redevelop that as an office tower. And they've just announced this week that they're in talks to sell about half of the office space to Alibaba for $900 million, which compares against the $2.6 billion market cap for Mandarin Oriental. So very material. So there's a lot of value in that, in those property assets.
Mm-hmm. It's one of those things. I mean, it's not unheard of for hotel chains to trade well below their real estate value, but when do you realize it, and do you really trust it? Let me ask. So, just on the 5-year shareholder returns, again, I completely understand the family holdco and everything, but to me, they trade at a NAV discount, and they clearly believe their NAV is way, way higher than the share price. I look at this, say, why aren't they buying back stock? The stock buyback is token at best, and basically zero if we're being honest with each other. They do pay the progressive dividend and everything, but if they're saying, hey, we want to deliver superior 5-year returns, there's nothing they could do that would deliver that better than buying back stock at under just market NAV, forget their NAV. Why do you think they aren't doing that? Because to me, that it's just like, again, we're dancing around the elephant in the room. I'm worried about empire building. It seems like a red flag here.
Yeah, it's a very good question. I mean, one obvious answer could be that, as I say, that the CEO hasn't actually sat at his desk yet. He joins 1st of December, so that presumably is something that's on the to-do list, to be a bit more aggressive about buying back the stock. I mean, as I mentioned with Mandarin Oriental, they have been selectively increasing their stakes in some of the main entities. The biggest entity by market cap is kind of, it's an intermediate holding company called Jardine Cycle and Carriage, and that holds the stake in Astra International, which is the Indonesian conglomerate, and they own 85% of that. Which I believe they've increased in recent years. So the one of the more obvious things that I think they are likely to do in the next couple of years is to buy out the 15% minority in Cycle and Carriage, which again simplifies the group, allows more of the dividends to accrue up to the top.
There's some interesting language in the annual report about board remuneration, incentive alignment, and everything. They've got the 1947 trust. Can you explain how the 1947 trust works to me?
No, short answer is no. So the 1947 trust is a one of the main family vehicles. I believe there are two family vehicles which own just over 25% of the company. But beyond that, I don't really know how decisions are made within the family and exactly how the trust works.
No, that's completely okay. There's this weird thing where, and again, it made my head spin when I was reading it. The 1947 trust, which again owns, I think it's 8% of the company, maybe 10, I can't remember the exact number, is controlled by the company and pays out dividends. And they use that dividend stream to, in part, pay the directors, who are then required to use some of that dividend stream money to buy shares on the open market. But the executive chairman, the fifth generation family member we've talked about, is the one who controls how much of the 1947 dividend goes to the directors. And I've just never seen anything like it before. And it strikes me as really weird because you could say, hey, huge alignment, right? They're getting dividends that they're forced to plow back into the stock. Huge alignment. On the other hand, you could say huge misalignment. A, they want to keep paying a dividend because that's how they're getting paid from the 1947 trust. And B, because the executive chairman decides how much of the dividends go to the directors, they need to stay on his good side no matter what, right? So if he's walking around wearing no clothes, they're going to say, hey, great suit, sir, because they kind of serve and get the dividends at his pleasure. Like, that was my understanding. I could have been wrong. It was very confusing. I'd never seen anything like it before, but that's kind of why I was asking about it.
Yeah. I mean, it's kind of how you might run a private family entity, right? It's as the owner of the business, as the family owner, it's kind of your discretion to decide how much equity somebody gets, how much they get paid. It's kind of like a private profit share. I would see it as.
I think you're exactly right. It's just the way it was structured was a little strange to me. I'd never seen before. Let me ask one last thing, and then we kind of wrap it up. Again, holdcos are difficult to talk about because, like, hey, NAV is 100. It trades at 80. Should it trade at 90? Is NAV actually 100 or 150? But it's tough to like really. Just ask, why Jardine Matheson, right? You laid out 15% discount to market NAV. You probably think NAV is, I'm just going to put words in your mouth, 25% understated. So that 16% is closer to 35 or 40%. But, I mentioned XOR. I think XOR, based on their numbers, trades at half or under half of NAV. IAC, $35 per share stock price, $40 per share in cash plus MGM stock plus other stuff that's probably worth another $10 per share. So that's trading at, if I'm doing that math in my head right, 70% of NAV. Pershing Square. There's a popular one, 27.5% discount to NAV. Obviously, there's fee issues, control issues, everything, but that's what comes with holdcos. I just listed 3. We could probably find 20 more. But why Jardine Matheson over any of these other kind of discounted holdcos that I just walked through?
Well, I think because of the delta, the change. I mean, this business, this industry is the job is filtering. And so anyone who's looked at Jardine Matheson over the past 30 years will have concluded, as I did a decade ago, horrible corporate governance, pass. And it takes a long time for people to really believe when something has fundamentally changed. And I see lots of evidence that change is happening, firstly. And secondly, there's just so much low-hanging fruit. I mean, we haven't even got into Astra International, which again is the Indonesian conglomerate. I mean, I was looking at it, and I believe I found 10 publicly listed subsidiaries of Astra, which itself is a subsidiary of a subsidiary. So there's a lot you can do to restructure, simplify, and realize value.
I mean, go with that. Anything in particular? Obviously, I was just focused mainly on the holdco, the NAV. But anything in particular you want to say about that one, or that you think is particularly interesting? Like, they've got, I think, if I remember correctly, that's a third of NAV. Is there a reason to believe that NAV is understated, or there's going to be some inflection point there, or anything?
Well, they've really said very little about Astra International, and I think one of the reasons for that is that again, it's the largest business in Indonesia by revenue. And so in some ways, it's almost like a quasi-state company. And so they have to be a little sensitive about the changes they make. I understand that BCG is in there, doing some sort of strategic review. And I just find it hard to believe that with all that's going on in all the other group companies, they will, there'll be nothing done at Astra International. As I say, it's incredibly complex with 10 listcos within the business. The main entity of Astra is the largest manufacturer and dealer of cars in Indonesia. So well over half, they're the exclusive distributor of Toyota. So well over half cars sold in Indonesia, which is a $250 million population country. And I think 80% of all, two-wheel motorbikes are sold and financed by this entity, Astra. So it's a massive business, and again is a sprawling conglomerate. So there's a lot that you can potentially do, and Indonesia is a very unpopular place at the moment with equity investors.
I'm just laughing because with 10 listed subs and the complexity of that, we can do a follow-up podcast on the holdco at Astra International. It reminds me of a little bit of Boyer in France, where you just get holdco discounts on holdco discounts, and one day then one. Cool. Well, look, I think we've gone through all my questions. I just want to, is there any asset that we covered? Obviously, we could go deeper into them, but I think this is more holdco. But any Astra asset that we haven't talked about, or that we kind of glanced over, that you think is just worth highlighting, or anything else that I kind of should be asking about Jardine Matheson that I haven't hit on?
Not really. I mean, yeah, you can get into the weeds, and there are so many. You can find more and more businesses. So, for example, in Asia, Schindler, which is the giant elevator manufacturer, Jardine Matheson is their JV partner. They run 1,000 Pizza Hut and KFC locations, mostly across Asia. So there's just, once you peel back the layers, there are so many businesses. And for me, given the evidence of change, that all of that creates optionality. Is
KFC still like kind of a dominant brand over in Asia?
It's generally pretty, very successful.
Okay, I just remember when I was, 10 years ago, when I was up and coming, everybody talked about KFC over in China. It's nothing like KFC over here. Like it is the place. It is the hot, it's upscale. It's where everybody wants to eat. I wasn't sure if that had changed at all in the past 10 years.
Yeah, I think it still continues to do very well.
Cool. Okay, well, this has been great. Look, Dom has a great write-up on his Substack. I'll include a link in the show notes if you want to go there. And it includes, as Dom mentioned at the top, 200 years of history of Jardine Matheson. He's been following it for 12 years, how to sell on it. The stock, again, I laugh at their annual report because we want to deliver superior 5-year returns, and 10-year return negative. But it may, did it work for them? No, but it might just work for us now. But Dom St. George from Cayucos, this has been great. Thanks so much, and looking forward to chatting soon.
Thanks a lot, Andrew.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.